Saks Global is bankrupt. $2.2 billion in debt. Creditors are circling. Store closures are imminent. Thousands of jobs are at risk. The iconic Fifth Avenue store is shuttering. A supplier who's worked with Saks for 20 years is left unpaid. The luxury market is rattled, control has slipped, the board is fractured. No one can say who's steering Saks now. The takeover was supposed to save them. Instead, it triggered a collapse. The question, if Saks can fall, who's safe? This wasn't just a failed deal. It exposed a deeper fault line in luxury retail. Power shifted overnight from seasoned operators to financial engineers. The old guard lost control. The new owners promised growth but delivered chaos. Suppliers are unpaid. Landlords are furious. Even rival brands are nervous. Saks' collapse isn't isolated. It's a warning shot. The luxury market's stability is now in question. Saks wasn't always vulnerable. For decades, it was a fortress of high-end retail, loyal customers, prime locations, strong vendor relationships. But the market changed. E-commerce squeezed margins. Real estate costs soared. Private equity circled, sensing opportunity. The takeover came fast. The buyers weren't retailers, they were financiers. Their playbook, leverage the balance sheet, extract value, move on. Saks became a vehicle for debt, not a brand for growth. The boardroom changed. So did the priorities. But the mechanism that broke Saks wasn't just debt, it was the way incentives shifted. The new owners needed quick returns. They cut costs, sold assets, and loaded the company with obligations, short-term wins, long-term risk. The old Saks was built for endurance. The new Saks was built for extraction. Here's how the collapse became inevitable. The takeover was financed with layers of debt, secured, unsecured, mezzanine. Each layer came with covenants and deadlines. Saks' cash flow was strong, but not infinite. The new owners refinanced real estate, sold off inventory, and issued high-yield bonds. On paper, the balance sheet looked aggressive but manageable, but the incentives were misaligned. The financiers earned fees and bonuses for closing deals, not for running stores. Every decision favored immediate liquidity. Inventory was slashed. Marketing budgets were gutted. Vendor payments were stretched. The stores lost their edge. Less staff, fewer exclusive lines, declining service. Loyal customers noticed. Sales softened. One board member reportedly said, "We're not running a store anymore. We're running from debt." Meanwhile, debt service mounted. Interest payments ate into operating cash. When a single quarter missed projections, lenders tightened terms. Saks had to sell more assets to stay afloat. Each sale weakened the core business. The cycle accelerated. Landlords demanded rent. Vendors demanded payment. Employees faced layoffs. The boardroom fractured. Some wanted to restructure, others to liquidate. The inflection point came when Saks defaulted on a major loan. Creditors triggered covenants. Suddenly, the company lost access to working capital. Store closures began. The brand's reputation, once its greatest asset, became a liability. No one wanted to supply a retailer in freefall. Customers fled. The luxury market, watching closely, saw a giant stumble. The moment of breakdown was not a single event, it was a cascade. The default triggered a liquidity crisis. The board could not agree on a rescue. At the emergency board meeting, half the directors walked out, refusing to sign off on another asset sale. Lenders moved to seize assets. Employees were left in limbo. The bankruptcy filing was the final admission. Control was lost. The takeover, meant to revitalize Saks, had hollowed it out instead. Saks' collapse is not just about one company. It's about what happens when financial engineering overtakes operational discipline. The incentives that drove the takeover were not aligned with the long-term health of the business. Debt can amplify returns, but it also amplifies risk. When the focus shifts from customers to creditors, the brand erodes. The luxury market depends on trust, exclusivity, and stability. Saks' fall shows how quickly those can vanish when capital is misallocated. Other luxury retailers are watching. Many have similar ownership structures. The warning is clear. If incentives reward extraction over endurance, collapse is only a matter of time. Saks' bankruptcy is not an outlier. It's a signal. When control shifts from operators to financiers, the rules change. Brands built over decades can unravel in months. The luxury market's veneer of stability is thinner than it looks. In the end, the real risk isn't competition. It's the quiet, compounding pressure of misaligned incentives, and once control is lost, it rarely returns. Capital Rifts, where money breaks.